Well, I'm here today with Daniel and Andrew from Prerequisite Capital Management, and we're here to have a discussion about equities. So I guess the first question is, Andrew, what is an equity?
An equity is a share of the business, a share of a company. More importantly, a share over the future performance of that company. Now, when we're looking at a balance sheet, we're looking at the top. We've got our assets, and those assets are funded in part by liabilities, which are obligations the company needs to fulfill into the future. And then really the surplus is funded by the equity portion within the business. Now, when we're talking about a share, we're taking really a share of that equity in that organisation. Right. So when we're hopefully, if we've purchased a share in a business, it's utilising its resources well enough to essentially be accretive or grow in value. Yeah. And over time, the more profitable the business becomes, and the more sustainably profitable the business becomes, the higher the value of that equity, and thus the higher the value of our share inside that business.
So we have this thing called equity markets.
Yes.
And so that looks at not so much at a business level, but more even at a national level sometimes.
That's right. So when we're looking at an equity market, so the market is where all the shares of those businesses are traded among participants, myself, yourself, inside and into and out of our own portfolios, and that'll form an important part of our our balance, our diversification strategy to ensure that we achieve the results that we set out to. Alongside our equities, we will also have exposures to bonds, we'll also have exposures to precious metals, and they all come together to create a portfolio that is set out to achieve the mandates that we are looking to achieve.
Of course. So when we think about equities in terms of, are we using the term asset class? Is that work?
Sure. Yep.
Inside of a portfolio?
Yep.
What are some of the drivers that we need to keep an eye out for that exist within equities?
First off is earnings and earnings potential, and then the prospect of future strength in earnings. Earnings is obviously that profit path, and when we're talking on an asset class level or a security level, we're talking a pooling of profits across that market,
right?
And really how that is divvied up among each individual security.
Right.
So the pooling of the earnings across that region, especially if we're talking at an index level or an asset class level.
Right.
What is the profit pool or the pool of profits that economy is actually generating?
Right.
Right. Now, this is a slightly different way of looking at it in first instance to what most people are familiar with, because we're looking at it at a macro level first.
Yeah.
Right. We're not looking at BHP or pick a company and going, what are their earnings and what are their potential earnings? We're going, okay, this macro economy within this region, like Australia or the US or wherever, in the way that economy or that economic system is functioning, how is that generating profits? And where's the profit cycle at? And what are the influences to, at the margin, increase or decrease profits and profitability in that region? And so there's a lot of different drivers to that at a macroeconomic level that you wouldn't normally appreciate if all you do is look at individual company type profitability. And so, we spend a lot of time watching those component drivers of that macroeconomic level of profitability in order to sort of ultimately gain leading indications on the earnings cycles and all of this sort of thing. Yeah, and then even at a subset of that, we have a look at how credit cycles and volatility cycles sort of complement that earnings cycle picture as well. And it sort of rounds out, because if we have a bit of a sense for the potential earnings in that economic system, we have a bit of a sense for at least the earnings contributor to equity market performance, moving forward.
You mentioned there were other...
Yeah, so we're looking at valuation multiples as well. And so the whole idea behind that is that the value of $1 of earnings is not necessarily going to be the same today as it will be next week. Right. There are a number of factors that arrive or that drive into that. Yeah, so once we've got an idea of the profit cycle and where things are headed or where those profit pools are and how they're either expanding or contracting, we then look at how investors are valuing that profit pool and really the multiples that they're placing on that.
Right.
One of the underappreciated factors that drive multiple, either expansion or contraction, comes back to capital flows again.
Right.
Okay, so if more capital is flooding into a region, say America or Australia, depending wherever, if capital is coming in for whatever reason, it tends to be bidding up assets, right, or placing a higher valuation sort of multiple on the existing stock of assets. So multiples tend to expand. Vice versa, if capital is leaving the country, then there'll be depressive effects on the valuation multiples. Right. What people don't understand about valuation is that valuation is an effect, right? The cause is actually the concentration or dispersal of capital. If capital is concentrating into a market, capital is flowing in, it will drive up the valuation, right? It'll bid it up.
Yeah, of course.
And so the valuation is an effect on that. Now we can get overvalued.
I mean, this happens in the housing market, right?
Yeah, that's right. What happens in every asset class, right? You can get an overvalued situation, the valuation that the market is placing on a set of cash flows or earning streams or whatever. In this case, it's the earning streams or the ownership of that company. Whatever the valuation multiple is, if it gets ridiculously expensive, a lot of people will go, well, that's too expensive, I'm going to avoid that altogether. But if they look at the feedback loops in the broader system that is causing the capital to keep clustering into that, either stock or region of the world or industry sector or whatever, valuations can go from expensive to ridiculous to, just bizarre, but it's a secondary effect of capital flow. Right. So capital flows are primary, valuation is secondary. Right. And this happens not just between country to country, but within economic regions or within a country from different asset classes. A preference shift or a change in regulation will incentivize different behavior, capital. And so, but the flip side of this is that capital can concentrate into a particular asset class or market and bid up the valuations to ridiculous levels. And it can keep concentrating in there, but eventually, the more the capital concentrates, the more problematic future returns, or the more eventually what comes in will either, will be at risk of going out or deflating, or especially if it was an artificially driven or unsustainable flow of capital into that asset class. And so you really need to be careful around the underpinnings of how these valuation multiples are moving and what's moving them, and are these feedback loops in that broader system sustainable or unsustainable, healthy,
can you describe
weak?
when you use the term feedback loop, what you mean by that?
The most oversimplified sort of example, actually is probably in property, is a good example of a positive feedback loop within an asset class. Yeah. People understand property prices. So the property market starts to go up generally across the board. That basically gets the attention of more people. Oh, property's going up. They want to become more active in property. So they become more active in property. So greater capital is attracted into that space. They go and borrow more. Banks are more willing to lend because
the valuation's increased.
The valuation's increased. The collateral value from their lending point of view is increasing. People are more willing to take on debt because they want to get greater participation in the price rises and all of this sort of stuff. And so what we end up having is a price rise begetting more activity and more...
hence the term feedback loop.
Yes, and also more indebtedness and more willingness to go out there on the risk curve, so to speak, in participating in this. And even the banks become progressively more complacent and go, well, property only ever goes up, so,
and so this
we'll
same
ease
principle.
the lending standards, give people more money, and they're more willing to take it anyway. And it's a feedback loop that bids up valuation. And obviously, that's also an example of an unsustainable dynamic too, past a point. Because if everyone takes on too much debt, too much exposure, can't handle any unexpected surprises, especially if negative, either in their personal situation or in the broader economy, if something wobbles or whatever, then all of a sudden a lot of that debt is revealed to be what it is, which is unsustainable.
Right. And so the same thing happens in the equity markets.
Well, yeah, basically that's an example of a positive feedback loop. Right. And while that loop is intact, the valuations can get more and more ridiculous. So prices just keep going and higher and higher and higher. Past a point, something will short circuit that feedback loop. Right, so some sort of shock to the economy or something, and some people lose their jobs, they can't pay a mortgage, that causes a bit of forced selling at the margin, right? And they can't pay back their debt, or the bank has to basically take action for non-repayment or forced selling or whatever it is. That feedback loop is short-circuited, prices start to fall a little bit, that makes other people at the margin a bit more nervous, especially the other ones that are over-indebted. And it can actually kick into reverse. Right, and then so falling prices put lots of people underwater and in pain. Banks start to freak out and they restrict their lending activity and tighten their terms, stop giving people money towards property, or put higher requirements on.
So you have a negative feedback.
Yeah, then that's a negative feedback loop. And so the same sort of dynamics, like that's a simple example that people can sort of understand. The same things happen in most asset classes, right? Especially the equity market. But usually it's a little bit harder to discern some of these different feedback loops, especially, because people are trained to be able to understand valuation in a sense. They are not actually trained to understand capital flows and the behavior of money, and how it moves and participants and things. Now there's a whole field called behavioral finance, but even there, it's too academic for their own good, basically.
So you talked about this third element that we want to talk about for a minute that affect the equity markets. So what is that terminology?
Asset collateral production is what we're looking at.
So can you define that for me?
Daniel touched upon it there through his explanation.
Right.
Well, because we're analysing that broader system,
Yeah.
right? So it's what's the earning capacity of that system?
Right.
One, profits, profitability, and future profitability. Number two, what is the valuation being placed on that profitability? So the valuation of those assets. Number three is a bit more of a tangential sort of dynamic. So any economic system will be effectively manufacturing assets, right? Now, an asset can be, houses, businesses, even liabilities. So one person's liability is often another person's asset, like a bond. Someone borrows the money. So like a bank that lends, someone takes out a mortgage from the bank. It's a loan, or it's a liability to the person. They've got to pay it back. But to the bank, it's an asset, right? And the bank can often will actually sell that asset on, or sell that loan to someone else, for a price or a different yield. So the economic system's capacity to generate assets. Right. And so that asset pool in the economy is either expanding or contracting. Right. Now, a certain percentage of those assets are going to be funded by debt type securities, just like a balance sheet. And a certain percentage, or the leftover, will be their equity percentage. So in an economy at a macro level, if the system is operating well and it's generating, it's actually manufacturing assets to a large degree. This is why it's asset collateral production. And I use the word collateral, or we use the word collateral, because it's kind of that concept of cash and bonds and liabilities, but more from a collateral point of view as opposed to equity. It's sort of a bit of an expanded discussion. But so what's the ability of the economy to produce and generate assets? Now, if the economy is actually, or that economic system is producing greater amounts of assets, then the value of their equity is going to naturally increase too, right, corresponding to that. And so there's a few different ways to look at that. Soon we'll dive into some more practical examples and I'll explain it further, but it generally speaking, if you see growth in the manufacture of cash and collateral type assets, fixed income instruments and products. Now this is talking in quantity terms, not quality terms, because you can expand, you can create cash, and you can also create lots of liabilities that are someone else's assets, but they may or may not be sustainable or matched to productive activity in the economy, right? But as a general rule of thumb, one of the underappreciated macro level drivers of broader equity markets is that capacity to manufacture cash and collateral that actually has economic value. Because if collateral, so cash and say fixed income instruments, so all of the bonds and loans and different things all put together in an economy with the cash, if that's increasing in quantity and it's retaining its value, then that's like another way of looking at the asset value of that economy is increasing, and so the equity proportion of that asset thing also tends to get dragged up too.
Right.
And so driver number one, earnings and earning cycles.
Yep.
And driver number two, the valuation multiples on that earnings. And the valuation multiple, obviously, one of the underappreciated dynamics is the capital flow, capital concentration issue. Driver number three is this asset collateral production capacity in the economy, right? You put those three things together and you basically explain equity markets at that broader macro level, because they're the three drivers.
Yeah. Can you give us some examples of what they look like?
Yeah, so at the moment, that what we've just talked about kind of is a little bit abstract, especially this asset collateral value stuff. But obviously in everything we do, we want to operationalize abstract concepts into practical data-driven realities, because we want to be able to see what we're doing. Even if it's an imperfect sampling of that reality, it's better than no objective data-driven, at all. So an example of that, what that looks like in a practical data-driven format, is this. So this is in the US, but we can do this for every major region of the world. This simply maps the marginal drivers of those three things. So in orange is the marginal contribution of profits or earnings, growth or contraction. So if it's above the line, it's growing. If it's below, it's contracting. So it's a negative pull.
Right.
The green is the multiple expansion, the valuation. It's either expanding, multiples are expanding, or they're contracting. And then in the blue, the light blue, is that asset production function. It's either expanding or contracting. And the way we measure that is basically adding up all of the cash and fixed income instruments, including loans, in an economy or an economic system. And then we can see if that is all increasing in quantity and it's holding its value, right, then that's reflective of the broader asset base expanding in that system. And so that's a positive drag, that's a positive sort of pull on the value of equities, right? And that's, that third pillar is probably one of the more underappreciated drivers of equities generally. Now, they kind of, in academic literature, it comes close to getting at this concept through concepts like a portfolio rebalance channel and different things. Because if all of a sudden, like in aggregate, portfolios have more cash and bonds in them, then they've got to rebalance to keep their weightings into equities.
Right.
And so that that portfolio rebalance channel is sort of like an academic portfolio management concept that starts to approximate some of what I'm talking about there. And so when those three contributors, this darker blue line is the net effect of all of them put together. So when it's negative, that's obviously usually when we have negative performance in the equity market. When it's positive, it's usually positive performance, You can actually get, like here, from 2003 through to 2007, you actually had a net negative, drag from valuation models, multiples staying constrained or even depressed. So the green in negative. earnings were positive, so I had a positive earnings cycle, a positive contribution, but just a massive expansion of cash and collateral in the economy. So that production of assets just went nuts. And it was actually that was the biggest driver of this bull market from 2003 to 2007 in the US.
Created the GFC.
Which then, so a lot of that collateral that was created was unsustainable. Right, or poorly constructed, and a lot of risk miscalculation occurred, especially in the latter years here. But that's a bigger story. But the net effect in dark blue of those three drivers, you can see it actually turned net positive ahead of when the equity market turned up, which implies a mispricing at the macro level of equities, right? And then gradually it deteriorated in strength, in contribution, but equity markets continued to rally as if, we're set for life and all we're going to do is grow till trees touch the sky and all of this sort of thing. It ended up rolling over into negative, and then we had the price adjustment, seeing the equities collapsed. And so that's kind of, like, if you can't measure it, you can't really be objective about it. Now, these are not perfect tools, but they're better than not having them at all. And they're data-driven, somewhat timely. But this is only one example of how we triangulate what's going on in these categories. I mean, most of our analysis that we do is, focused around trying to develop and triangulate greater insight into these different drivers. But when you summarize it all, that's basically what drives equity markets at that broader cyclical level.
Okay, so you've given us a really great understanding of equities and the way in which we can understand how in which they move, and this is obviously at a cyclical level. Talk to us now about how this applies in more of a tactical, zoomed in.
So when we zoom into the shorter term sub-cycles, so this is broader cyclical multi-year, with a cycle typically being every 7 to 10 years-ish. And so those broader economic cycles even. When we start to talk about tactical timeframes, it's a very shorter term sort of swings. It could be, so every cycle of 7 to 10 years could have 3 or 4 sub-cycles, each being 2 to 3 years each. So sub-cycles within a broader cycle. So this is a cyclical framework to understanding what is going on within an economic system and how that translates at a broader level to equity prices. At a more tactical level, or the shorter term sub-cycle level, one of the most useful frameworks is more thinking in terms of markets being a balancing of liquidity, so a matching of buying and selling, demand and supply, all of this sort of thing. And so measuring and mapping the movement of money, and also the extremes that participant behaviours and the participants of any given market or the equity market in this situation, where they're at in terms of their pendulum swings from becoming too optimistic and complacent and all of this sort of thing to the reverse of that, being too pessimistic. If everyone's bought in a market effectively, who's left to buy to cause it to go up? There's only potential sellers, right? If everyone's sold on the flip side and everyone's pessimistic, doesn't want to borrow of that market, so they'll think it's going to go down forever, then who's left to buy? There's only potential buyers, so it's a potential turning point. Right, so we've got to pay attention to the extremes in positioning and then also the amount of liquidity and money available and that is being directed towards that money. It's sort of like a subset version of the capital flow type understanding that we kind of were talking about earlier. So there's a lot of dimensions around that liquidity flow. Now, one of the things, this is our tactical framework, and so each one of these things has a whole world of different analysis tools and techniques and things that you dive down. Some of them are conventional, some are less conventional. We'll probably, in some of these examples, we'll talk about the less conventional ones.
Yeah, great.
So at the end of the day, the flow and dispersal of liquidity within the market, the behavioural thresholds and movement, so at what price levels within the equity market is going to basically trap certain subsets of participants. If I know with a high probability that there's a huge chunk of participants are going to be trapped, put in a lot of pain past a price point, and they're going to be forced to reverse their position. So if they were long, if they'd bought a heap of the equity market and past a point, they're going to be suffering losses from that entry level. They're going to be forced past a point to just capitulate and basically sell, even though they're selling lower and just realizing losses, basically.
Yeah.
They're trapped, they're forced selling. And in that situation, all you have are the people who think the market's going down, so they've already sold or potentially willing to keep selling. But all those guys, all the people who were long, who thought the market was going to go up, the buyers, now are in so much pain that they have to sell too, just to stop the pain.
Right.
So all you have is a heap of sellers and the price collapse, so it cascades.
Just feedback.
Yes, which is a different version or a smaller
Of the feedback loop.
subset of a feedback loop.
Yeah.
And so we want to know where those pain thresholds are for the different participant groups, right?
Of course, yeah.
'Cause that'd be pretty useful to know.
Absolutely.
If you know past this level, that's going to trap some group of participants. They're going to be forced to unwind, or they'll be in a bit of pain, and you're going to basically have a cascading market where you've got an overabundance of suppliers, right? If everyone was underexposed or short and past a level, it's going to force them to reverse and buy and push the price up in a big way. Or a cascading market lower in terms of trapped and forced sellers. Anyway, so we want to know that from a behavioural threshold and movement and behaviour of money and participants and all of that sort of stuff. Creditworthiness factors. So in the capital structure of a balance sheet, basically you have, it goes basically liabilities and then equities. There's different types of liabilities. So people who lend money to that business have different levels of seniority or claims. So in the event that the business has insufficient cash flows or earnings, then equity gets wiped out first, and then another lower quality version of whoever the liability holders are, like the riskier tranches of bonds, bondholders, all the way up to the more secured creditors who have basically they're last in line to get hurt. Now, when you're talking about the credit aspects of people and participants who lend to businesses, basically they're incentivized to assess reality of cash flows. Am I going to get paid back if I lend this money into this business? The equity holders, however, they're more forward-looking and they're more predicated on forward-looking hope and confidence. I think this business is going to be amazing. They're going to take over the world. That's profits are going to increase. Right. And so simplistically speaking, it's the credit markets are going to have a little bit more of a realistic
perspective on...
They don't really care as much about the hopeful scenarios. They're like, have you got cash? You're going to pay me back when it's due.
Yeah, their upside is capped.
Yeah,
yes,
so absolutely.
And so they're whereas the equity holders are going to be like, let's just ignore all those risks to cash flow. Earnings are going to be great anyway. Let's go. The reason I'm saying this is that assessing the way the credit markets are behaving, either for an individual stock or for the broader equity market as a whole, has information value. Because if you know that as a general rule, they're going to be a little bit more in touch with reality than the equity pricing, then you're going to take some cues. And typically, more often than not, you will often get leading indicators from credit market activity for equity prices, equity pricing. Because sometimes equities, they can get a bit carried away. Also, just as a fact, in any given economic system, or especially the US, the credit markets, the fixed income markets are massive. They're huge compared to the value of the equity markets. And so there's a lot of money, and very sophisticated money, pricing those credit markets. But that's another aspect. The price of liquidity, which is just like saying the price of liquidity, practically speaking, is volatility. Bit of a can of worms for another time. The originators of liquidity, so where does money come from? How does it get supplied? And how does it get directed towards the equity market? Are those sources of liquidity intact or not?
Yeah.
If it's, international net contribution or withdrawal of liquidity. So if there's capital flowing into the US and particularly towards equities, and that's fantastic, that'll be a positive. Yeah. And vice versa. If capital's going away, there's less, or liquidity detractors out of that US system. And then risks of liquidity shocks. So there's a lot of different ways we do that. Some of them are actually sampled and explained there, but one of the practical ways that's a bit unique is we're able to track basically money flows and behaviours of different participant groups. And so when we oversimplify it, this is sort of one of our main tactical frameworks from a data-driven perspective, timely up to the, up to time equal, like now. So it's a very timely way of being able to generate this data. So speculative participants, people that are just trading in markets looking to, they have views on the movement of price and they're willing to even use leverage, but they're more momentum driven, just chasing price up and down, trying to make money, is here in blue. And so when they're buying too much or buying at an extreme versus totally pessimistic and washed out, don't know when want to take. So obviously here, totally washed out, very negative. Typically is, if everyone's out, who's left to sell? There's more potential buyers than sellers type thing. And same on the reverse. That's why the peaks here often coincide with intermediate peaks in price. This chart's up to the end of 18, which then led into pretty significant corrections in the equity market, but over speculative again. Too many people are optimistic. Too many have bought more potential sellers than buyers, and so it typically higher probability top. The patient money flows is more like your institutional, larger. So where these guys will even use leverage to gain exposure to a market and just follow price up and down, basically. These guys have more of an investment perspective, multi-year, and so at the margin they're going to allocate money into or out of the share market at different points of time. And they tend to be a little bit more counter-cyclical in their actions. So here in 2009, for example, when you had the speculative crowd and most people washed out, didn't want to touch equities, the patient money crowd were buying hand over fist in this instance. On the flip side, they were actually selling here.
Right.
Selling or distributing at the margin their holdings here. So they're a bit more fundamentally focused and have a multi-year time frame, usually not funded by leverage, so they can be patient.
Yes.
So knowing what they're doing, what the speculators doing, and then this is the underlying liquidity in this market. And there's many ways of looking at this, but this is like the broader flows that are occurring from the broader system and financial system that is coming in that is not accounted for by speculative or patient money participants. So it's almost like the residual after this.
Yeah, what's left after that?
Yeah, and so you can kind of get a sense for inherently strong or inherently weak markets depending on what liquidity profile is under them. So when we look at this underlying liquidity, we can see here, here's a classic example where the market was still selling off, everyone's getting really pessimistic and basically washed out. You're seeing patient money accumulation again at the margin, but the underlying liquidity has actually turned very strong, right? There's a huge demand of inherent strength and flows from the broader system coming in, underpinning it. Some people will describe this as like passive flows as opposed to active flows, but that's a bigger conversation for another time. But here, coming up to this over-speculative condition, underlying liquidity was actually relatively weak under that. So it was not making new highs. So at this run-up, it was still fairly strong. Liquidity collapsed. It wasn't that over-speculative, and they weren't really too extreme either in buying or selling. Liquidity collapsed and prices soon corrected. Liquidity kind of flagged, but this run-up was entirely speculative. These guys thought, especially this last half, that price had got too far to what was justified by fundamentals, and they started selling on balance. And we could see here a very weak construct, a very weak underpinning from the broader system of what was going on. And so this is sort of like one aspect of assessing the tactical swings in equities, you know. And so if we can look at any analysis target from a multitude of perspectives, unrelated to each other, and we're glimpsing reality and we're seeing the same underpinnings coming through, that increases our conviction that we're seeing reality. So if we kind of analyze these drivers and we can see them, you know, actually here on a cyclical basis, they were still reasonably strong, right? We weren't really in bear market territory. And so any correction, you know, it's likely to be a correction within a broader trend as opposed to a cyclical change of trend. But you could see the hallmarks, and even at the bottom of this correction, you know, you get the speculative washout to some degree, a little bit of accumulation or buying from the more patient money crowd. Liquidity was still fairly average. This is the global share market, by the way, so all the share markets put together around the world. We just aggregate these flows for the major regions to represent the same sort of weighting as the global market weightings. And so that's one aspect. Another aspect of understanding these little blue diamonds are what we call liquidity turning points. So they're major and minor. Minor is a hollow, major is a full diamond. Basically, when the positioning of participants in a market gets to a critical mass level, so everyone's positioned effectively the same way across all sorts of time frames. So this is more mathematically determined, so completely unrelated methodology to the others. But when they reach those critical mass conditions, it's a high probability of potentially being a turn, right? Because you've got the diversity of opinion within that marketplace has collapsed to basically zero. Everyone has the same opinion and the same positioning across all time frames. And when you get that critical mass, you normally getting potential, like high probabilities of turning points, either a change of trend or the beginning of a correction or the end of a correction. And so when they trigger, it's just kind of like a warning sign. So, you know, soldiers out in the jungle, overnight, they'll often set up tripwires and warning flares or claymore mines or something. And so if the enemy approaches while they're sleeping, they trip and they trigger these signals, like a flare or a claymore mine going off or whatever. This is like an alert system. Go, hey, we're getting a bit overdone. Positioning of participants are becoming too unified. Yeah, it's a useful tool, not a perfect. So when these things trigger, it's like a greater than 70% probability that we're at a turn or a beginning of a correction or changed momentum structure or something.
Some of your other instruments in combination with this give you guys
a three-dimensional picture. Yeah, I mean, most people are only operating off price.
Yeah.
And there's this whole field of analysis called technical analysis, which is basically just calibrated off price. You know, whereas a lot of these sorts of tools let us look beneath the surface of what's going on to see what is really, you know, going on and how it's comprised and the quality of liquidity or lack of, extremes in participant behavior, etc. So here is an example of, so this is real money. We'll just skip over the leverage. Participant behavior, so bulls and bears. So a bull is someone who thinks the price is going to go up and they'll get long, and then bears are people who are trying to sell the share market short, like trying to make money from prices falling. So this is predicated on a lot of behavioral analysis over the years, like just like some of these other tools, and those thresholds at which they switch from confidence to pain, we've basically been able to determine. Now this applies to any market, whether it's commodities, currencies, bonds. It's the same, people are people. They have the same sort of parameters to what constitutes pain, what they can tolerate relative to their positioning or their view. So above the line here means bulls are in control, they're confident, and if it's too far above, then they're way too confident or max confident. It doesn't speak to the quality or the underpinnings of their confidence, but we can see it. Below that line means they've been trapped, right? And they're in pain. They're underwater or they're on the sidelines. They don't want to come in, to the point of just see you later, I'm not in it. So here you can see at these lows, bulls have been completely washed out. So this is a leveraged speculative crowd. And this is the bears, leveraged bears. So people are short selling stocks and operating on a shorter term basis and potentially even using leverage like through equity index futures or something. So their max point of confidence is when they've made the most money, basically. But this threshold where it flips is where they get trapped. And so you can see these have been underwater. So in this bear market of 2008 into early 09, the bears are in control, making a lot of money too and get ridiculous levels of confidence, right? Bulls have been completely washed out. Now, it was only about this level in price that the bears became trapped. They were either short or still trying to get short, right? And that flipped to being they're trapped. They have to unwind, so they have to buy, right? Or they have to basically step aside altogether and not come in with their new shorts. Bulls got control again, and so you start to get that cascading upwards, and same vice versa. Here, we got like whatever it is, 6 to 7 years of leveraged bulls in control. They got stopped out about here, didn't believe it at first, got suckered into it again, but then got totally roasted and the market collapsed as they were forced to unwind, right? Because they were, anyway, so knowing these thresholds for the leveraged speculative community, and this marries up to a lot of what they call commitment of trader reports, especially in currencies and commodities where it's really useful, and the COT reports are a little bit more accurate. You see it dovetails because they're reporting their longs and shorts of different groups, and anyway. And this is a real money crowd, so people who are not using leverage have multi-year time horizons, institutions, pension funds, all of this sort of stuff, knowing where they get trapped is also very intriguing. And it gives you a sense for how overexposed or extended a market is. Anyway, so there's a lot of different ways where we can triangulate. We want that three-dimensional insight into what is going on.
Yeah, I think that's what I'm picking up from most of the content that we're talking about at the moment is your ability to step back and gain a broader perspective than the average person.
Absolutely.
Stepping outside of the system and looking at the system as opposed to being in it.
Yeah, and we try to do it in a data-driven way. So we're just not another person with a bunch of opinions, but no data.
Yeah, that's right.
And that allows objectivity, it allows other people to even challenge us. Because it's like, hey, it's changed. They can assess, even on these models, you can kind of even, because of the history is so extensive on all of these things.
And because you are one step removed and you are looking at it from that macro level, you're somewhat detached from the emotional connection to the decision making. And when
there's still other traps, especially in managing money, where you can still get emotional and blind yourself even. But, for example, a lot of this stuff appears in a lot of our research and research reports that is published that our clients read, and so they can understand the assumptions and the frameworks that we're looking through and the assumptions we're making ahead of time and also in real time. They can also see these sorts of charts and models and data-driven sort of insights into this phenomena. And they can challenge us.
Yeah.
And it's very hard for us to remain, if we fall in love with an idea, but even our published data is going in a different direction.
Right, yeah.
We're absolutely going to have clients calling up going, hey, you're saying this and you're doing this, but this data is moving in that way. And it's like...
But you built such unique data sets that most other people don't have.
I mean, you combine data with broader insight and context, and it's a competitive advantage at the very minimum.
Yeah, absolutely. Based upon everything we've just discussed about equity markets, the question I have is that there are obviously good times and also bad times to be in the thick of the equity markets.
Now, we don't want to promote that we're timing markets too much, right? We don't want to.
Right.
So if you came in here Like you're an average investor off the street and you went to your advisor and probably you think the equity market's going to keep going up anyway or whatever. You want to get into equities, your advisor's probably like, sweet, let's go, sign you up, but you're not realizing that you're seeing a deteriorating liquidity profile, you're over speculative, you know, distribution from the patient money, stronger hands, you know, more fundamentally driven crowd. Probably not probabilistically the best time in the world to jump straight into equities. So you probably need to be just a little bit more cautious, depending on your time horizons and all of this sort of stuff. But yeah, I mean, like we're not trying to time markets too much, especially to the portfolio mandates we manage, because we're fairly conservative and we need to maintain resiliency profiles and we're low volatility, all of this sort of thing. This insight absolutely could fuel a more aggressive mandate.
Yeah, absolutely.
If you really wanted to assume risk in a big way, but for our existing portfolios that we run on behalf of clients and our own families, we're a bit more conservative. So even, you know, we have diversification principles that we adhere to that keeps us fairly balanced. You know, other principles that kind of cause us to be a little bit more or less exposed to different asset classes at different times. And then at the margin, we use this sort of analysis and insight to just sort of tweak it further, you know, and wash it all out together across the asset classes. We have very low volatility, reasonably, you know, high consistency of returns, fairly conservative returns, but that's what we're here for, to be that resilient solution amidst a very crazy changing world.
Yeah, absolutely.
And having liquidity tools, being able to follow the money so closely at such detail and see beneath the surface of price, you know, we're better empowered to be able to, you know, at the margin, you know, do the right thing in portfolios. Now, don't always get it right, but more often than not, we don't do too bad because we have a foundation and a process and a set of tools to help give rise to insight when we kind of need it.
Brilliant. Thank you for that.
Yeah.